The easiest way to make sure your house never collapses is to leave the ceiling where it is and raise the floor. Apparently, Treasury Secretary Scott Bessent has taken this to heart and decided that he would rather have a flatter yield curve by forcing long-term rates lower than let the free market do its thing. Mainstream pundits are hailing this as a pro-growth move, but we all know that larger and well-rated corporations benefit when long-term borrowing becomes cheaper, while smaller or riskier folks, the backbone of the real economy, are left with more expensive or limited access to credit. Scott's pulling it off by shifting new bond issuance to shorter maturities and limiting supply at the long end, effectively capping long-term yields. Sure, that can drive up asset prices, especially for the mega-cap growth companies that drive most indexes, and make it look like all is fine and dandy. But beneath the surface, more liquidity for giant corporations doesn't necessarily create jobs or raise wages. If anything, the big players keep rolling over cheap debt, while small caps and your local entrepreneurial hero can't catch a breath. The herd sees a Fed that may eventually pause or cut rates, the wealth effect of rising stock prices, and calls it a win. It's an illusion. Scott's yield curve engineering leads to capital misallocation, crushes regional banks' net interest margins, and stifles real economic growth. Also, the market can keep dancing for another quarter. Is this brilliant or just another short-term patch in a system that avoids real price discovery? You decide. I, for one, sniff out illusions before they start to stink. A goose in equity valuations doesn't solve structural debt problems or the fact that outside of those big corporations, credit is still expensive. Flattening the curve can be a nice parlor trick until the real economy calls time on the show.